Welcome back, and today we'll take up chapter 10 where we deal with issues regarding inventory. We begin with the first learning objective: describe the types of inventory and demonstrate accounting under periodic and perpetual inventory systems. There are two types of inventory: manufacturing inventory and merchandising inventory. Manufacturing inventory includes raw materials, work in process, and finished goods. There are two types of inventory systems. First is the periodic, in which the ending inventory balance and cost of goods sold are determined at the end of each accounting period. The second type is called perpetual, in which the inventory accounts and continually updated by purchase. The cost of goods sold is recorded after each sale. In our second learning objective, we will discuss inventory costing, including accounting for goods in transit, consigned goods, costs included in inventory, and purchase discounts. This is a fairly lengthy list here. Let's take a quick look. Goods in transit are items that have left the seller's place of business but have not yet arrived or been received by the buyer. FOB, free on board shipping point, means that title passes to the buyer when the goods are shipped. The seller does not include these goods in inventory after shipment. FOB destination means that title passes to the buyer when the goods are received, rather than simply when they're shipped. The goods remain in the seller's inventory until they arrive at the buyer's destination. FOB is a term meaning freight on board. Once we begin the shipping process, the freight is literally on board. Truck, plane, or boat, however it goes. A consignment arrangement occurs when one party, the consignee, agrees to sell a product to another party on behalf of the other party, the consignor, without taking ownership of the merchandise. Consignment is a very frequent process, particularly now in e-commerce, where the merchandise is sold, but once the merchandise is sold, possession changes hands. Freight in transportation costs are incurred in order to bring the inventory to the appropriate location and are included in the cost of inventory. Freight out costs consist of transportation costs incurred to move the inventory to the buyer. Freight out costs are expensed as occurred. So slightly different treatment there, worth noting. Purchase discounts are reductions in the comparative revenue, or in the company's revenue from sellers as they pay for purchases within a certain time period. There are two methods of account for a purchase discount. First is the gross method. The company initially records the inventory and accounts payable at the full gross purchase price. Second is the net method. The company assumes that it will take the discount and initially records the accounts payable and inventory at the net amount. So a matter of timing on the discounts. Of course, if we use the second method and the discount is not received, we need a reversing entry. Our third learning objective, we take a look at the need for inventory cost flow assumptions and calculate inventory and the cost of goods sold under the inventory allocation methods: specific identification, moving average, last in, first out, and first in, first out, also called LIFO and FIFO. Cost flow assumptions are needed because inventory costs are tracked separately from the physical flow of inventory. There are four common inventory allocation methods. The specific identification method, this is used to identify each unit and keeps track of the cost of each unit individually. This works well for items like cars or other large ticket items where the individual item can be followed and tracked and costed separate from all others. The moving average or weighted average, also called method, the company determines an average cost for the inventory on hand and applies that average cost to each sale to determine the cost of goods sold. First in, first out method, the company assigns the most recent inventory cost to ending inventory and the oldest costs to the cost of goods sold. The last in, first out method is just the opposite. The company assigns the oldest inventory cost to the ending inventory and the most recent cost to the cost of goods sold. This, of course, has a pronounced effect on income, and we'll see how that works. Also on taxes, because anything that affects income affects taxes. Learning Objective 4 will demonstrate an understanding and illustrate the accounting for LIFO and reserves and the LIFO effect, LIFO liquidations, and will compute inventory and cost of goods sold using the dollar value LIFO method. In Learning Objective number 5, we explain the lower of cost or market. Under generally accepted principles in the U.S., the market value is measured as the amount at which the inventory could be currently purchased or reproduced and is known as the current replacement cost, CRC, current replacement cost. To calculate a write-down, determine the market value of the inventory, complete the market value to cost, or compare the market value to cost, record the write-down if the market value is less than the costs. A write-down simply means we devalue the price or cost basis of our inventory because events have caused it to degrade in value. The CRC cannot exceed a ceiling that is equal to the net realizable value. Net realizable value is the item's selling price less the cost of disposal. CRC cannot be below a floor value or net realizable value less than a normal profit margin. Net value minus normal profit can't be below that amount. Calculating number 6. Objective, calculate inventory and cost of goods sold using the retail inventory method. And here we cover a number of bullet points, but we'll summarize quickly. The conventional retail inventory method is an allowed approximation of ending inventory that takes into consideration the replacement that inventory be reported at the lower of cost or value. The conventional retail method approximates the lowest of cost or market rule by including net markups but not markdowns in the cost to retail ratio. Net markdowns are deducted from the retail inventory in a write-down reflecting the inventory loss of utility. Not deducting the net markdowns from the denominator of the cost to retail ratio lowers the ratio and compares it to the purchase of markdowns in the calculation, resulting in a lower reported ending inventory. Learning Objective number 7, explaining the gross profit method of estimating inventory. The gross profit method estimates ending inventory as cost of goods available for sale less estimated cost of goods sold. Estimated cost of goods sold is based on sales to date multiplied by 1 minus the estimated gross profit percentage. And finally, we turn to our last objective, details required disclosures for inventory. Required disclosures include the following 5. Number 1, the accounting policy, including the company's inventory costing method and the measurement basis. Secondly, carrying amounts by type. Third, inventory financing arrangements. Number 4, carrying amount of inventory carried at an amount less than the cost and the amount of write-downs recognized as expenses. And finally, the use of LIFO costing method when applicable, including the LIFO reserve for replacement cost of inventory, and to compute the reserve and the effects of any LIFO to liquidations. Liquidations meaning selling off of inventory at lower than market prices. And that concludes chapter 10 and concludes the semester. You have a final exam to take. Be diligent on that, and a couple of brief exercises to be detailed in your syllabus. Thank you for taking this class. I hope you're able to take accounting in the next cycle, which begins the week after this. Again, good luck and do well. Thank you.